The Atlanta Fed, I don't want to get too technical here, but the Atlanta Fed first off said we're going to grow at 5% this year. They've scaled it all the way back down to a growth rate of 1.9%. Is this a sign that our economy is slowing down a bit? Retired economics professor Peter Morici is with us now.
I'm an emeritus professor.
Oh, okay, I get that right. Emeritus professor. Okay, I'm just trying to work that one out. Now, are we slowing down?
Yes, we are. We're having our usual winter doldrums. It's not as bad as last year, but we seem to be having it. Economists had hoped that the tax cut would avoid that, but it hasn't. What's been going on since the financial crisis is that consumers take a pause in January and February to pay off their credit cards and regroup after the holidays. They're simply not running down to the bank and taking out a home equity loan so they can keep on spending. It's that simple.
Okay, so we are slowing down. Now, I want to show you this. It's a headline from FoxNews.com. The headline is, 10 years after the financial crisis, Uncle Sam could trigger the next one. Well, Peter, you wrote that article.
Yes, I did.
Yeah, I know you did. So are you talking about the debt bomb? Is that what you're talking about here?
Well, yes, and I'm not talking about it the way people normally do. You know, 110% of GDP or something like this. What really matters is what Americans owe the rest of the world, between the government and, private debt, and what they owe us. And on a net basis, that's around 45% or so now. Once it gets to 60%, you're getting in the territory that Greece, Spain, Ireland were in. No major country has crossed the 60% threshold without enduring some sort of major financial adjustment. Read crisis.
Okay.
Now, we do print the world's money, but it doesn't do us any good if people won't buy the bonds, because that's really what they buy, is the bonds, not the money. And we're starting to see U.S. Treasury securities losing their premium in international bond markets. And just a couple of weeks ago, when the Treasury rate went up, foreign investors didn't rush in to grab them. They're not considered as risk-free as they used to be, which tells me we're starting to get to the point.
So when do we get to that 60% threshold?
Sometime in the next 5 to 10 years.
Well, that's a long way off, Peter.
Well, no, not when you got $1 trillion deficits and they're getting bigger every year. We thought it was good until we had the tax cut and the recent budget deal. It was about 10 years out, on the track we were on. Now it's a lot closer. And if they spend some more money without financing it, it'll even be closer. For example, an infrastructure program that is not financed by revenue. This is serious stuff. You can get to the point where your debt's unmanageable. What happens is we'll have to pay higher and higher interest rates to finance the debt, and then that will become a secular thing, and that feedback. Either we cut spending, or we borrow some more, and that pushes up the interest rate even further. And you get to the point where the bond market basically disciplines the government into cutting the deficit.
The trouble is with the debt bomb story is that it's always years away before it actually hits. So people don't care about it because it's not hit yet.
Well, the thing is, once it's within 2 years away, it's awfully tough to put it off. You start to get it to the point where you're selling your parking meters and parking spaces in the airport and things like that. This is something that has to be addressed now. It wasn't addressed now. I've liberal Democratic economists around town say to me, Peter, I don't believe that the government will ever run out of money. No, it won't, but it can print so much of it that nobody takes it.
Got it. All right, Peter, thank you for joining us. We'll see you again real soon.